How a company trades. Arthur and Ben set up a company. Arthur invests £50 and Ben invests £50. They can now create the balance sheet of the company. Remember, the balance sheet is a snapshot in time for a business. It shows the assets and the liabilities at a particular point in time and nothing else. In this case, the assets are £100 cash and there are no liabilities to third parties. Net assets are therefore £100. The investment by the shareholders is £100 and the company has not yet made any profits from trading activities. Arthur and Ben take their £100 and go to meet George, who is selling apples for £1 each. Arthur and Ben agree to buy 100 apples in exchange for £100 in cash. Now, who owns the apples? Arthur and Ben, of course, or at least their company does. And what do they want to do with the apples? They want to sell them. So they go and visit Harry. Harry has £500 and wants to buy the apples. So Arthur and Ben exchange the apples with Harry for the £500. Now, who owns the apples? Harry does, which means that the transaction is complete and Arthur and Ben can record the sale in their accounts. So while the assets and liabilities of a business sit in the balance sheet, the sales and expenses sit in the profit and loss account or income statement. The balance sheet represents a snapshot in time, that is, the assets and liabilities of the business at a specific point in time, whereas the income statement or profit and loss account reflects the sales made and costs incurred over a period of time. And so Arthur and Ben can reflect the fact that they sold the apples for £500, having bought them for £100, making a £400 profit during day one. At the end of day one, their balance sheet shows assets of £500 cash. Remember, they started the day with £100 of cash. They used that cash to buy apples, which they then sold for £500 cash. They have no liabilities. We're going to ignore tax in this example, and so their net assets are £500. This is represented by the shareholders' funds, which shows the initial investment of £100 plus £400 being the total profit the company has made ever since it started trading and has not yet returned to the shareholders. If Arthur and Ben were to put their company into liquidation, then each would receive £250, i.e. half of the £500. That £250 would be made up of their original stake of £50 plus their 50% share of the £400 of retained profit. But they don't want to wind up the company, they want to carry on trading. So they go back and see George, who is still selling apples for £1 each. Unfortunately, both Arthur and Ben forgot to bring any cash with them. But George is very understanding and says that he will accept an IOU instead. And so Arthur and Ben buy the apples from George with a promise to pay George at some point in the future. Now again, we can ask the question, who owns the apples? Well, the answer is Arthur and Ben. There's a pretty easy test. If Arthur and Ben drop the apples in the street and they get run over by a car, whose problem is it? It's Arthur and Ben's problem. And so we can see that title of ownership has passed from George to Arthur and Ben, even though Arthur and Ben have not yet actually paid for the apples yet. So what do Arthur and Ben want to do with the apples? They want to sell them. So they go and see Harry. Unfortunately, Harry does not have any money, even though he wants to buy the apples. So Arthur and Ben tell Harry that they will accept an IOU instead. Harry agrees, and so the transaction takes place. Harry gets the apples, and Arthur and Ben get the IOU. Now, who owns the apples? The answer is Harry does, and so Arthur and Ben can record the transaction in their books. In their profit and loss account, they record the sale to Harry for £500 on credit, and the purchase from George of £100 again on credit, and the profit on the transaction of £400. And they can then prepare their balance sheet at the end of day two. They still have £500 of cash. That is the £500 they started the day with, but forgot to take with them when they went to meet George to buy the apples. They also have the £500 which is owed to them by Harry. This is known as a debtor or account receivable. They also have a liability. That's the amount that they owe to George of £100. This is known as a creditor or account payable. Their net assets are therefore £900. That's £500 cash plus £500 debtor less the £100 creditor. The original investment still remains as £100, and at the beginning of the day they had £400 of retained profit. Now they've made an additional £400 of profit during day 2, and, because they have not paid a dividend, now owe a total of £800 back to the shareholders. 100 plus 800 makes £900, and so the balance sheet continues to balance. Day 3, and all this trading is very tiring, so Arthur and Ben decide to go and see Harry to collect their debts. Harry has the £500 he owes Arthur and Ben, so he pays them, and Arthur and Ben cancel the IOU. Of that £500 that they receive from Harry, Arthur and Ben keep 400 and take the other 100 and go and see George. They give the £100 to George, paying off their liability. They then return home and record the transaction in their accounts. There were no sales or costs during the day, so their profit and loss account is blank. But they've turned the £500 debtor into cash and have used £100 to pay off the creditor, leaving them with £400 cash to add to the original £500 cash that they started the day with. This leaves them with £900 cash in total. The shareholders' funds remains as it did at the beginning of the day, and thus we see how a company trades, and the relationship between the balance sheet, a snapshot in time reflecting the assets and liabilities of the business, with the profit and loss account or income statement, which reflects the sales made and costs incurred over a period of time. We should also note the following important point. During day 1, we started the day with £100 in cash and finished with £500 cash. The total amount of cash increased by 400, and the profit for the period was also 400. During day 2, we started with 500 in cash and finished the day with 500 in cash. So there was no increase in cash during this period. But the profit for day 2 was £400. And finally, during day 3, we started the day with 500 in cash. We finished with 900 in cash, an increase of £400. But we did not make a profit during the period. And so we now see that profit and cash are not the same thing. It is possible to make a profit without generating any additional cash, as happened on day 2, and it is possible to generate cash without making a profit, as happened on day 3. This is due to the accruals or matching concept. This accounting concept says that we recognize the sale when we earn it, not when we receive the cash, and we recognize a cost when we incur it, not when we physically pay for it. And that is how a company trades.